A laundromat can look like passive income. Customers load the machines, and you collect the money. Before you risk household critical cash, we'll test whether the records, lease, equipment, and cash flow can cover the debt and pay for the labor that buys back your time. Because the real asset isn't the washer, it's the operating system around it. After 40, a business mistake doesn't land in an empty life. It lands beside retirement plans, housing, health, work, and people who may depend on you. But experience can help. You may be better at reading records, negotiating, managing vendors, and rejecting a deal that only works on optimistic assumptions. So we're testing both sides: the risk you can carry, the judgment you can bring, and what you must protect. We're comparing two paths: buying an operating laundromat and building a new one. To keep the comparison honest, both paths will use the same illustrative store once they're stabilized. What changes is the capital burden, the ramp, and the proof required before you commit. Here's the early direction. For this after 40 viewer, acquisition looks stronger than building from zero. But that is not permission to buy a random laundromat. The asset label proves nothing. A defensible deal must pass 4 gates. First, the revenue and expenses have to reconcile across records from matching periods. Second, the lease needs enough runway, workable assignment rights, and no hidden utility or rent surprise. Third, the equipment and infrastructure need inspection, service history, and a funded replacement plan. Fourth, conservative cash flow must cover operating costs, debt, reserves, and market rate labor to replace your routine work. If those gates fail, the answer is not try harder. The answer may be walk away. At the storefront level, the customer is buying access, convenience, capacity, and time around a recurring household task. That's an editorial description of the value proposition, not proof of demand in a particular neighborhood. The revenue engine starts with paid washer cycles. Count the paid cycles. Multiply them by the realized vend price. Then add dryer revenue, wash, dry, fold, or other services if they actually exist, and other operating revenue that can be reconciled. The word paid matters. Test cycles, free starts, refunds, sales tax, and non-operating deposits can distort the picture if the seller and buyer are counting different things. Demographics can help you screen a market. For example, census data lets you calculate renter shares for cities. But renter share does not tell you how many homes lack laundry, how strong the nearby competitors are, what price customers will accept, or how many paid turns your machines will achieve. That takes local evidence, site observation, competitor visits, machine and payment records, utilities, bank deposits, tax returns, and matching period financial statements. A familiar neighborhood story is not a demand study. And if the seller reports revenue, test it against at least 2 independent evidence categories. The goal isn't to catch someone, it's to avoid paying for cash flow that disappears after closing. Now let's separate the 2 entry paths. Our illustrative acquisition starts with a $575,000 purchase price. Add $35,000 for initial improvements, $15,000 for transaction and financing fees, and $25,000 for opening working capital. That brings total uses to $650,000. At 30% equity, the buyer contributes $195,000 and borrows $455,000. The illustrative new build is much heavier. We use $550,000 for equipment and fixtures, $400,000 for construction and utility infrastructure, $100,000 for design, permits, and connection fees, and $150,000 for pre-opening costs and working capital. Total uses, $1.2 million. At the same 30% equity assumption, that is $360,000 in equity and $840,000 in debt. These are not market averages, bids, valuations, or lending offers. They are controlled assumptions used to compare paths. For financing, both examples assume 10% over 10 years. Again, not a current quote. Under that assumption, annual debt service is about $72,154 for the acquisition, and $133,208 for the build. So before the new store earns $1 extra, its modeled annual debt burden is about $61,000 higher. Buying concentrates risk in a different place: the truth of the records, the lease transfer, equipment condition, and how much work the current owner is really doing. Building concentrates risk in site control, utility capacity, approvals, construction, equipment, working capital, and the time required for customers to find the store. Published utility schedules can show bill components. They cannot tell you the cost of your future store. Meter size, usage, sewer treatment, taxes, demand charges, machine specifications, and local rules still need site-specific bills, plans, quotes, and professional review. Now we can build revenue from the bottom up. Our standardized example has 40 washer positions and 40 dryer pockets. It operates 365 days a year. The assumed blended washer vend price is $6. The three cases change one core operating variable, paid washer turns per day, 2.5 in the conservative case, 4 in the base case, 5.5 in the strong case. Those are assumptions. They are not national averages, and demographics do not prove them. Let's walk through the base case. 40 washers multiplied by 4 paid turns per day equals 160 paid washer cycles a day. Multiply by 365 days. That gives 58,400 washer cycles a year. Multiply by the $6 realized vend price. Washer revenue becomes $350,400. The model then estimates dryer revenue at 45% of washer revenue. That adds $157,680. Other revenue is estimated at 3% of washer plus dryer revenue. That adds roughly $15,242. Put those pieces together, and base case annual gross revenue is approximately $523,322. Run the same formula at 2.5 turns, and the conservative case is about $327,077. At 5.5 turns, the strong case is about $719,568. That is a spread of almost $393,000 created by one utilization assumption. This is why laundry is recurring is not enough. The decision depends on paid turns at this location, at a realizable price, after competition, downtime, refunds, and local demand. And remember, every number we just calculated is gross revenue. None of it is yet owner cash flow. From gross revenue, the model subtracts water and energy, volume-related labor, processing, marketing, occupancy, fixed payroll, maintenance reserve, insurance, software and administration, waste, internet, and security. These are illustrative. A real store still needs its lease, bills, quotes, and equipment history. Then we count the owner's work. The stabilized estimate is 14 scheduled hours plus 4 on-call hours each week. At $35 an hour, replacing those 18 hours costs $32,760 a year. Count that cost before calling the result owner-independent cash flow. Now, the scenario reveal. These figures are cash after owner replacement and debt, before tax and depreciation. For the acquisition, the conservative case is negative $104,681. The base case is positive $33,459. The strong case is positive $171,598. For the build, the conservative case is negative $165,735. The base case is negative $27,595. The strong case is positive $110,545. Same store, different debt. In the base case, acquisition finishes about $61,054 ahead. The positive base case is thin in transition. Modeled year one acquisition cash after debt is only about $7,900. Every modeled year one build ramp case remains negative. The workbook and owner hour phase table differ by $1,260 in owner labor. Every case remains negative either way. Finally, break even. Under these assumptions, stabilized break even after owner replacement and debt is about 3.64 washer turns a day for acquisition and 4.30 for build. In this model, turns per day is the primary destroy variable. Occupancy and the entry path debt burden are next among the variables tested. That answers the buy versus build question. Acquisition is stronger here, but the conservative case still loses money. Cash flow is only half the ownership test. The other half is when the work shows up. Our illustrative acquisition assumes 14 hours a week during 10 weeks of diligence, then 35 hours a week during a 12-week transition. For a new build, the model uses 30 hours a week through 40 weeks of development, then 46 hours a week during a 12-week opening and ramp. After stabilization, both paths use 18 hours a week, including 4 hours of on-call burden. These are estimates, not typical hours. Public operator accounts conflict sharply. In one public discussion, 3 anonymous self-reported accounts range from about 10 routine hours a week to 35 or 50, depending on store count, staffing, repairs, training, and marketing problems. A separate success-selected account reported roughly 1 management hour a week, but the records and full paid labor substitution were not available. So don't shop for the anecdote you prefer. Map the tasks. Who handles cleaning, refunds, attending callouts, collections and payment controls, bookkeeping review, vendor coordination, repairs, security incidents, the customer who needs help when you are somewhere else? If the answer is the owner, that time belongs in the decision. If the answer is someone else, that person's pay belongs in the financial model. Systemization is not removing work from the spreadsheet. It is deciding who does the work, how they know what good looks like, and what happens when the normal process fails. Routine cleaning can be assigned. Attendant coverage can be scheduled. Bookkeeping can be contracted. Preventive maintenance can follow a calendar. Some customer response, reporting, and payment monitoring can be supported by software. But the system needs written controls. Opening and closing, collections, refunds, incident reports, maintenance schedules, staffing backups, vendor escalation, and a weekly owner dashboard. Remote monitoring and payment systems may help. Their hardware, integration, processing, support, and financing costs still need transaction-specific quotes. The real test is resilience. Can the store function while you are on vacation? What happens when an attendant does not arrive? When several machines fail? When there is a customer or security incident? If every exception pulls you back into routine fulfillment, the business is not yet owner independent. And systemization affects the exit. A buyer can evaluate a long assignable lease, reconciled records, maintained equipment, trained staff, procedures, reserves, and reduced owner dependence. An asking price or the word absentee cannot substitute for those things. This is how a laundromat can buy back time. Verified margin pays for labor, vendors, controls, and management. The machines alone never do it. Now, put the business back into your life. Recovery runway. Could you absorb a weak transition, major repairs, or a delayed ramp without needing the business to rescue the household? Household exposure. Can you fund the equity, diligence, and reserves without risking money your family cannot safely lose? Schedule and health. Can diligence, transition, on-call duty, and emergency weeks fit your work, caregiving, and physical reality? Experience advantage. Can your background in people, vendors, negotiation, cash controls, or procedures improve the operation and help you reject bad assumptions? Exit clock. Is there enough lease and operating runway to reduce owner dependence before you expect to sell or step back? A business can be viable on paper and still be wrong for your household right now. That is not failure. That is a useful decision made before the expensive part. Here is the ownership scorecard. 1 is least favorable. 5 is most favorable. We do not average the categories because a fatal weakness cannot be rescued by a pretty total. For acquisition, capital required, 2 out of 5. Time to dependable revenue, 3. Cash flow quality, 2. Stabilized owner hours, 3. Systemization potential, 3. Exit or resale value, 3. For a new build, capital, 1. Time to dependable revenue, 1. Cash flow quality, 1. Stabilized owner hours, 3. Systemization, 3. Exit or resale value, 2. So the preliminary verdict is, buy it, then systemize it, but only when verified operations can pay the debt, replacement reserves, and the labor required to remove you from routine fulfillment without exposing household critical capital. This is a stronger fit if you can protect a household reserve, tolerate diligence and transition, apply mature judgment, pay for labor and systems, and walk away from unreconciled records or weak lease terms. Avoid it if you need passive income immediately, must risk household critical capital, cannot absorb a weak year or major repairs, or need optimistic turns, unpaid owner labor, or a promised resale multiple. The verdict improves with reconciled multi-year records, a durable assignable lease, equipment and infrastructure inspections, site-specific demand evidence, real quotes, a funded downside reserve, and a staffing plan. It worsens with weaker verified terms or pricing, higher occupancy or debt, larger capital needs, or evidence that paid owner replacement removes the remaining return. Buy verified cash flow. Fund the system that buys back your time. Otherwise, walk away before the machines become the most expensive job you own. A vending machine or micro-market business can appear to lower the entry cost and make the equipment movable. But route density, location agreements, stocking, shrink, technology, and driving time may become the real ownership test. That is a candidate for a future episode, not a scheduled promise. Until then, tell me in the comments which business you want tested next.